All right, well, good afternoon and welcome to this SW financial reporting event specifically for financial services entities, wherever you may be joining us from. I am Renee Miller. I'm a partner with SW and I will be moderating today's session. It is great to have so many of you on the line today. Firstly, I'd like to acknowledge the traditional custodians throughout Australia and the connection to land, sea and community. And we pay our respect to the elders past, present and emerging. Our presenters today, joining me on the line, are Rami Al-Chalabi, a partner in our AAD division, who will talk about AFSL compliance today. I will then cover a more general compliance update and also give you a bit of an accounting standards update for financial services entities. Then Simon Tucker, one of our tax partners, will provide a tax update for financial services entities. And then Rami and I will run through some of the hot topics for the 30 June 2022 reporting cycle. Before we start, I'd like to run through some housekeeping. We recommend that you click on the Enter Full Screen button at the top right-hand corner to achieve the best webinar experience. If you click the Q&A button at the bottom of your screen, a window will pop up that will allow you to send us questions as we go. We will monitor these and answer any questions that we can during the presentations. And some we will save for the Q&A at the end of the session, but for more bespoke questions, we may need to connect with you after the session. We will circulate the slides for this webinar after the webinar today. Before we kick off, just a little bit of information as well. We will be running a live poll today. The poll question will appear on your screen after our first presentation, and we'll share the results with you later in the session. But first, without any further ado, I will hand over to Rami Al-Chalabi.
Thank you, Renee. Now, hopefully that's coming through. Good afternoon, everyone. Thanks for having me as your guest today, Renee. Very excited to be here. Before I get moving through and talk about the riveting topic of AFSL compliance, I kind of wanted everyone just to pause for a moment and remember that if you're working in the financial services sector, you're in a really privileged position. You got the opportunity and you've got the privilege to actually look after other people's money and assets. And I think that's a really important thing you should keep in mind when you turn your mind to compliance, because we need regulation, we need to build confidence in markets, we need really skilled people to be able to look after other people's money. And AFSL compliance is, a really important pillar to give confidence to your clients. Okay, so let me work through some of the content that I have in store for you today. Why do you need an AFSL? Well, the law says you have to have one, but for the reasons I mentioned. Okay, we need authorised people to operate financial services in Australia. It's really important for confidence. Who needs an AFSL? Well, pretty much everybody who's providing financial services. That's a pretty broad definition. But if you're providing advice, general specific financial product advice, if you're dealing in financial products, if you're making markets, if you're operating a registered scheme or an unregistered scheme, if you're a custody for other people's assets, there's a whole range of services and financial services that can be done that are captured under the legislation. But if you're unsure, please speak to a lawyer. Invariably, you're not going to fall in one of the exemptions and you're likely to need an AFSL. Let me touch on some jargon. This sector is full of it, full of jargon. Let me talk about authorised representatives, or ARs, or CARs is the corporate version, the corporate authorised representative. They're important people. Within your business, within your regulatory regime, you will have some authorised representatives. They are the responsible people under the Act to have oversight and deliver the financial services under your licence. Not necessarily could be directors, could not be directors, but you need authorised representatives. A managed investment scheme, or an MIS, is coined under the Corporations Act. It is an entity recognised under the Act. It's the common vehicle for retail investors to pool proceeds together and go and invest in a type of asset. Okay, so as an investor, you would contribute your money and you have a beneficial interest in the assets in proportion often to what you contribute. A responsible entity, often referred to as an RE, That is, for all intents and purposes, the trustee of a pooled investment vehicle. So the responsible entity itself is a term under the Corporations Act. It's the term used for the trustee of a registered managed investment scheme. I'm sure there are plenty of people that have responsible entities on today's call. Finally, another piece of jargon I wanted to talk about was net tangible assets, or NTA, often a requirement for those that are in this sector, not always, but many have this requirement to hold sufficient NTA. Very easy to remember the acronym, sometimes a little harder to calculate it, and we'll talk about some of the challenges with that specifically. I want to do a refresh on the audit requirements because they are specific to this sector. So the AFSL holder needs to have an audit of its financial statements for all intents and purposes, an audit like most other audits you'd be experienced with. What is different though is the compliance audits. And for those that are new to the sector, this will be new for you. Please be across this early and understand what's required. Effectively, the auditor will go and sign off that you've complied with the relevant financial conditions under your license and those that are consistent with the regulatory guide RG 166. Understand which conditions are relevant. Please make sure you're calculating these things correctly because these are checked through the audit process. One little 4-point for later in today's presentation, when Renee is talking about some changes to general purpose financial reporting, this affects AFSL holders, so please tune in for that. For those that are all operating wholesale funds, generally, there is no statutory requirement to conduct an audit. Without saying that though, we're seeing many of our clients that are in that space are still opting in for audits on the back of really building increased financial confidence and trust in their numbers for their investors. That's a trend that's probably emerging over the last 3 to 5 years that we're seeing more and more of that. For those operating a retail managed investment scheme, that's an entity captured under the Corporations Act. You must have an audit. You need to have one at the half year or a review engagement at the half year where you have more than 100 investors in your fund. And you also need to have a particular document lodged with ASIC called a compliance plan. That plan sets out how the responsible entity will make sure that the fund is administered in accordance with the Act. That's a separate audit, just to make things straightforward. AFSLs and RG 166. RG 166 is the go-to guide. It's long. It's not an easy read, I must say, but it does have many of the answers in relation to financial conditions for your license. I'm looking at that document all the time. It is something that you do need to go and use as a reference guide. Every licensee has base financial requirements. As I mentioned to you, if you're going to be trusted with other people's money, you need to have a good financial health and baseline. So it says, you basically have to have solvency and positive net assets. That's a base level requirement. Seems straightforward. You need to be able to manage cash flow and forecast your cash needs. And that's something that is, again, a base requirement. And if you're a responsible entity or a custody provider, you have different requirements. Okay, there are specialized requirements, and I've seen people make mistakes with those. And there's also a tailored audit requirement, which I mentioned a little earlier. In addition to those base requirements, there are what we call additional financial requirements, depending on the type of services you provide. So if you're in the business of being a responsible entity or providing custody, often the case custody where you're doing property funds and holding assets on behalf of the fund, particularly in the wholesale space, you need to maintain your NTA requirements. The other point which can be overlooked, but will come up a little bit later when I talk about some ASIC enforcement, is the auditor is required and the licensee must have an effective risk management system to manage financial risk. It's not a policy, it's a system, and you need to think about how that could be relevant in the times we're in. NTA, wanted to talk about this at a high level. I don't have any numbers, but I want to talk about what you need to be wary of. It starts with your balance sheet. Oh yeah, that's easy. We all prepare a balance sheet. That's where it starts, but it's not where it ends. When we calculate NTA, it's based on what we call adjusted assets and adjusted liabilities, that adjusted word being key. You need to understand what assets are there that are excluded from the calculation. This has surprised some people when I've said, this particular asset doesn't count. And they say, Rami, what do you mean it's an asset? It's an asset. And I said, well, it's not an adjusted asset. This asset's in fact an excluded asset, specifically excluded from the calculation of NTA. Be across what they are. If you've never seen them before, I would be surprised. It might not be that you're attuned to what they could be, but there are things like investments in associates, certain related party receivables, certain fees that could be aged. So if you're in the business of running a really lean NTA to maintain your requirements and often will sweep cash out as and when you do it, be really careful you're not using assets that can't be used for the purpose of the calculation. On the flip side, if you are looking to fund your NTA through some different types of instruments, there are types of instruments like ASIC approved subordinated debt, which can satisfy your NTA requirements without having to effectively raise new equity. I won't go into any more detail, but I guess what the point I'm getting at here is it's not just what your balance sheet says. There are particular cash requirements I said a little earlier. All I want to say about option one is if you're a custody provider or an RE and you're using option one, you've got it wrong. Okay, you need to be using the tailored requirements. Option one is it's one of the base level financial requirements. Maintain cash flows for at least 3 months, looking at obtaining an amount of cash 20% or greater of your future cash flows or your historical cash flows. You've got to make sure you document the assumptions. That's probably a point I would emphasize. But the question is, should you be using option 1, 2, 3, or should you be using the tailored requirements? That's the key. And I've seen a few clients in the wholesale space that when these rules were introduced a few years ago, continue to use option 1, and that's not correct. Okay. Be across this, it's more detailed than option 1, the tailored requirements. You need to have a cash flow for at least 12 months. In practice, don't just make it 12 months, because as soon as you're one day into your 12-month period, your cash flow is now for only 364 days, and that's not 12 months, and that means you're in breach. So always I advise maintain a cash flow forecast for at least 15 months, ideally 16, particularly if you're only getting these approved quarterly at directors' meetings, and that's one of the requirements actually. NTA issues. I want to talk about some of the contemporary issues coming up through AFSL audits. By far and away, the NTA issue has been the big one over the last 12 months. In relation to the audits of AFSLs, it's rare you see issues on the financial audit. You generally see most of the issues on that second audit, the compliance audit. Not calculating NTA correctly, I've seen a number of times in the last cycle. You know, we've done a bit of root cause analysis internally, and I'm pretty sure it stems from a lack of training and oversight. It's such a specialist area. There are not a lot of providers, firms out there that often provide training in this area. But, you know, I've seen scenarios where certain excluded assets weren't being removed from the calculation, seen scenarios where assumptions were not documented, and importantly, there were very limited systems over oversight of calculation of NTA. What I'd encourage you to do is, if some of this is a bit of a shock to you, or you're not sure what any of this is, please reach out to myself or Renee. We'd be happy to walk you through some of these issues. Finally, I want to talk a little bit about enforcement action. Anyone who subscribes to any ASIC's feed, you'll see daily their enforcement actions for company directors and various other entities and people around Australia. I wanted to pull out this one in particular because it's really interesting. It's a really modern issue. RI Advice Group have just had to pay $750,000 towards ASIC's costs for their enforcement action for breaching their AFSL license conditions. What condition do you ask? Well, it's not a financial one. It's a risk one. It's about having and failing to maintain adequate systems around cybersecurity to manage cybersecurity risks. Really interesting. This only came up this month. So we're sort of getting our heads around that at the moment as to, you know, what does all this mean? And it makes sense. If you're responsible for other people's money, as I mentioned, how do you make sure that you're managing the risks of cybersecurity when you're providing a financial services business? A couple of other ones that are somewhat relevant in relation to FS. The first one I put in the bucket of fee for no service. Sadly, it seems that that is still going on, or ASIC are still working their way through enforcement on the many organisations that got troubled with that. And then finally, similar about misleading disclosure and, you know, failing to report in time. So please be across your AFSL compliance. Perhaps not always the most interesting topic, but really, really important. There are plenty of people, including myself, Renee, and others at SW who do spend a lot of time working in this sector and happy to help. I'll pause there. And I'm going to hand back to you, Renee.
Great. Thanks, Rami. That was a great reminder of the regulatory environment for AFSL holders. As I mentioned at the start, we are running a live poll today. So the poll question will appear on your screen now, magically. And it can be accessed at any time during today's webinar. Once you've, by just clicking the poll button at the bottom of your screen, if you want to access it later, once you've answered the question, it will disappear and we will share the results with you at the end of the session today. So next up today, I am going to run through with you a bit of an update on compliance and accounting standards, the fun stuff. So the first thing I wanted to talk about today, as Rami mentioned briefly earlier, is financial reporting for AFSL holders. Now, if you're responsible for preparing the financial statements of an entity with an AFSL, you'll be forgiven for being a little bit confused as to what the accounts need to look like this year if you have historically done special purpose accounts. And that is because ASIC has not come out and specifically said what this new framework is going to look like for AFSL holders. And the reason why, which they explained to us informally in roundtables and other presentations that they have done on the topic, is that they're in caretaking mode at the moment until after the election, and they can't come out and change rules or make new rules right now. So we are expecting a press release maybe on Monday. So as soon as the election is over, we are expecting a media release from ASIC to say what the new financial reporting regime for AFSL holders will look like. So what they have done is they've told us informally what to expect in this press release that we're anxiously awaiting. So what they've said is they are going to allow some entities to do tier 2 general purpose financial reports, and others will need to do tier 1, so full general purpose financial statements. And so what they've said is they are going to give the specific entities that need to do full general purpose accounts, and that will be those with public accountability, those holding client monies, the responsible entities of managed investment schemes, and then some other specific entities that they are going to list, like, for example, wholesale electricity dealers, some insurance companies, and so on. Last week, or was it this week? I think in the past week, I did attend a meeting with ASIC where they did give us an update on their current thinking. And they said they are still thinking about allowing some AFSL holders, some small AFSL holders who've previously done special purpose financial statements. They're thinking of allowing them a 12-month extension before they need to apply general purpose accounts. Now, I wouldn't hold my breath and expect this to actually be the case in the next 2 weeks when we do get the release from ASIC, because I think what ASIC is hearing from stakeholders is that the difference between what the AASB is saying, which is no more special purpose, and then ASIC allowing some AFSL holders to prepare special purpose accounts for another 12 months, that gap is just too far to bridge, because an AFSL holder has to prepare accounts in accordance with Australian accounting standards. And ASIC, whilst ASIC is the regulatory body that oversees the Chapter 7 reporters, so AFSL entities, and the AASB oversees Chapter 2M reporting, that difference is just possibly a gap too far to bridge. So I probably wouldn't plan for continuing special purpose financial statements if that's what you've done in the past. But also, if that is what comes out in the next 2 weeks, that might be a pleasant surprise for some AFSL holders. So we'll see what happens. The next topic I wanted to run through today is just a brief summary of the financial reporting requirements for corporate collective investment vehicles, CCIV entities. Now, I'm not going to steal Simon's thunder because this is probably more relevant in terms of the tax framework and the tax issues that might be surrounding these entities. But just a brief update from me is this will form part of the Corporations Act from the 1st of July 2022. And it's a new type of entity specifically for funds management. The purpose of it is to align our Australian framework for such entities to international frameworks for similar entities, so it's better understood by offshore investors, and basically, in a nutshell, to encourage investment into Australia. It'll operate similar to a company limited by shares, and many features of registered schemes will still apply, such as needing a compliance plan. There will be a specific tax framework, which Simon will give us a bit more information on later, and it will be applicable to retail or wholesale funds. So there will be a requirement, so the financial reporting requirement will be for any sub-funds in a CCIV structure, they'll all be required to prepare financial statements, but the audit requirement will be for the retail CCIV entities and for the compliance plan component. If you have any questions on that, give us a shout. The other thing I wanted to mention today is in the last few months, ASIC published guidance on crypto assets related investment products. Now, I quite enjoyed this, actually, this guide to read. I thought it was quite good, but the interesting thing for me about this guide is that it seems to be ASIC's first real foray into crypto, and it seems to be them embracing the fact that crypto assets are here to stay, and they are going to probably be, you know, the ones who's going to have to regulate it in the future, or currently actually. And so rather than keeping silent on it, they seem to be embracing it and issuing best practice guidance on a number of things to do with crypto related assets, such as, you know, some guidance for market operators, product issuers, the admission and monitoring standards around these assets, custody, pricing methodology, disclosure and risk management, and so on. So if you are in this space and crypto assets is something you're looking at, I do actually recommend reading this guide. I quite enjoyed reading it, but that might just be because I'm a bit of a geek. The next item to touch on today is director identification numbers. Now, this isn't hot off the press. This has been out there for a few months, but it is now kind of the crux period when, if you haven't yet applied for director ID numbers for your directors, you really have until 30 November 2022 to apply. So really what it is all directors of a company, a registered body, or a foreign company in Australia need to apply for a director ID number. It's administered by the ATO, but registrations are via the ABRS website. And the purpose of it is to stop illegal phoenixing activities and to increase accountability and traceability of directors. So like I said, directors appointed before this came out have until 30 November 2022 to apply for a number. But from the 4th of April, so from last month, any new directors that's appointed to a company, to a directorship, needs to have their director ID before they're appointed. Now, there are significant penalties for anyone who fails to hold a director ID. So I've actually applied for mine. So it's actually quite easy, and I would recommend people do that. The next topic to run through is SIV fund audit requirements. So for those who don't know, an SIV fund is a significant investor visa scheme fund. So an applicant for a significant investor visa have certain requirements for to get their visa in terms of how much they have to invest and what types of assets they have to invest that funds into. And so a lot of fund managers have created funds specifically for SIV visa applicants so that the applicant can invest in specific funds that have complying assets in the fund. And then the investor or the visa applicant has confidence that it complies with the investments framework for these visa schemes. Now, from 1 July 2021, there have been a few changes to the SIV kind of regime. And some of the key changes have been the range of visas that require to maintain complying investments has been expanded. So there's more visa options for SIV applicants. There's a reduction of the investment period for some of the visa classes. Investments, some amendments to investment allocations in terms of what assets, classes and types you have to be invested in. And there's also a new audit requirement applicable to an SIV compliant fund. So the way it will work is the fund manager will come to their auditor, such as ourselves, and say, I have this fund that is specifically SIV compliant. And the auditor will then audit the compliance of that fund with the complying investments framework and issue an audit report to the fund manager. And the fund manager will give that audit report to all their investors who will attach it to their visa application. And then the other thing I'm going through today is an accounting standard update. So the good news is there's not that much happening new in accounting standards in the financial services space. I would say the reason is because removal of special purpose financial reporting has been the big focus area in accounting standards at the moment. So the regulators seem to have taken it easy on us in terms of making a lot of other amendments. So the two things I'm going to run through from an accounting standards change today is just a very brief snapshot of the removal of special purpose financial reporting. And also I'm just going to give you a little bit of a background on accounting for configuration or customization costs in a cloud computing arrangement. So the removal of special purpose financial statements, that was available, or that's been available for early adoption for a couple of years. So a lot of entities have already done that. And we did a 1-hour webinar on it. So if you want more information, if you want all the details, go have a look at our website where our webinar on that topic is available. And we run through all the ins and outs of that if you feel like you need help, or just give me a shout. But just as a really brief snapshot, those who will now be required to prepare general purpose accounts fall into two buckets. So either if you're required by law or regulation to prepare financial statements in accordance with Australian accounting standards, then those financial statements have to be general purpose financial statements. So that's, for example, anyone required by the Corporations Act, such as an AFSL holder, a large private entity, a foreign-owned company, to prepare accounts. All of that needs to be general purpose. Or the other bucket is if you're required by a document such as a trust deed, a partnership agreement, a loan agreement, etc. If you're required to prepare financial statements for that entity in accordance with Australian accounting standards, that's the key phrase, then those accounts need to be general purpose. Now, there is a grandfathering exception. So if your trust deed, for example, was prepared before 1 July 2021 and has not been changed since 1 July 2021, and it says the trust has to prepare accounts annually in accordance with Australian accounting standards, you are within the grandfathering condition, and it means you can continue to do special purpose accounts without being in breach of your trust deed. So what's the difference between Tier 1 and Tier 2 financial statements? So in terms of recognition and measurement, there's no difference. So Tier 2 simplified disclosures need to comply with all the recognition and measurement requirements of all the Australian accounting standards, same as full Tier 1 accounts. Special purpose accounts actually also were required to be prepared in accordance with the recognition and measurement requirements of all accounting standards. So you might not find any change there. And that's the actual numbers that you see in the accounts. In terms of consolidation and equity accounting, that is required under Tier 2 simplified disclosures, and it wasn't required under special purpose. So that's going to be the big difference for a lot of entities who are part of a group that in the past do special purpose accounts on a standalone basis and now would need to do a consolidated set of accounts and apply equity accounting. Under full IFRS, Tier 1, you obviously do everything. In terms of disclosures, a Tier 1 full IFRS entity have to comply with all the disclosure requirements of all the Australian accounting standards. But if you do a Tier 2 set of accounts, simplified disclosures, you only have to comply with the disclosure requirements specifically stated in AASB 1060, the simplified disclosure standard. Now that standard was based on IFRS for SMEs. So the idea being that a set of Tier 2 Australian financial statements will look very similar to a set of IFRS for SMEs set of accounts. Now, that doesn't mean the numbers will be the same, because IFRS for SMEs have a few interesting divergences in there in terms of the recognition and measurement requirements in IFRS for SMEs compared to full IFRS, which we didn't adopt. So that's just in terms of disclosures. So if you have any questions, give me a shout, but we're here to help. The other thing I wanted to run through is configuration or customization costs in a cloud computing arrangement. Now that's a bit of a mouthful, but in a nutshell, what that means is if you used software as a service, so you're using a software that someone else stores on their service or in a cloud or whatever, and you just pay a license fee to use it, you don't control that asset, that's not your asset. But if you've configured it and you've paid a lot of money to change it, to tailor it, to implement it, it's got your brand on it, etc. A lot of companies in the past had divergent practices of how that was accounted for. So a lot of companies would have capitalized that configuration and implementation cost for the software as a service, whereas others chose to expense it. And the reason for the divergence is because the accounting standards didn't directly address it. Then IFRIC came out in March 2021 and made an agenda decision on how to account for these. And now, if you know anything about IFRIC, if you don't know anything about IFRIC, let me explain to you how that works. Whatever IFRIC says forms part of the accounting standard that they're talking about. So IFRIC is the Interpretations Committee of the International Accounting Standards Board. And so as soon as they said, here's what we think you need to do, then it immediately becomes part of the accounting standards and we need to apply it. So that was effective immediately in March 2021. But the reason why I'm still talking about it now is because I am getting a lot of questions from a lot of companies at the moment preparing for 30 June 2022 who missed this last year and who are now realizing that they need to look into it. So if you haven't dealt with this yet, this is definitely something to just be on top of for your financial reporting. So following IFRIC's decision, a lot of these costs that people have previously capitalized needed to be written off, and there's a potential prior period error. And so if you think about what these costs represent, they don't necessarily always need to be written off. We've had a few clients where we've concluded that you can continue to recognize these as intangible assets. And the way that you go about looking at it is by saying, does my asset meet the definition of intangible asset? So is it separable and transferable? Do I control it? And does the entity get economic benefits from it? And so in a lot of situations where you have software as a service, it's not typically transferable, and control can be really difficult to demonstrate. But there are some cases where that configuration asset can actually be separated and can be sold on. And in those cases, you can actually potentially illustrate control, economic benefits, separable and transferable, in which case it might continue to be an intangible asset. And that brings me to the end of my update. I'm now going to hand over to Simon Tucker to give us a tax update for financial services entities. Simon.
Very little in the financial services space, really on the tax space. There was announced some changes to the employee share scheme provisions, really just some tweaking around the edges to perhaps make it slightly more concessional around simplified taxation and simplified valuation methodologies may have some relevance to those in the FS industry. Like all budgets, the federal opposition does have a right of reply. Again, really not much in there to write home about. Just some FBT exemptions for electric vehicles. Now, the CCIV regime, this is a fairly big ticket item. This is something that's been floating around in the financial services and funds management industry for many years. It has received royal assent and it will go live on 1 July this year. So the CCIV, as Renee had touched on, is a brand new form of corporate entity, and it will be used almost exclusively in the funds management industry. Effectively, is designed to replicate the commercial and tax attributes of a trust or an investment grade trust. Essentially, it's an umbrella vehicle. It's very similar in concept to a UCITS or a CCAV or other Cayman, if from Europe, or other, I suppose, Cayman Island vehicles they use for collective investment. Basically, it comprises of, must comprise of the corporate entity itself, the CCIV, and there will be, must have one or sub-trusts. So you can have multiple sub-trusts, and that's, I suppose, the attraction of this particular type of vehicle, because each sub-fund, is regarded as a separate legal entity, legally for I guess, under the Corporations Act, and also for income tax. The governance documents is a constitution as an ordinary company would have, and this will replace the need to have trust deeds for I suppose, multiple funds where you have multiple sub-funds. Now, I suppose from an income tax point of view, the idea is to have a CCIV taxed very similar, if not identically, to what's known as an attribution IT. So to be an AMIT, there's a number of requirements that you need to satisfy if in terms of a trust applying the provisions. For a CCIV, some of those requirements are switched off because of the nature and the legislative context of the CCIV. CCIV will need to satisfy the widely held and closely held conditions, and also will not be able to trade. That is, they need to be carrying on businesses within that are designated to be eligible investment businesses. So where you don't have a CIV that meets those conditions, it will default to an ordinary trust, and Division 6, which is the ordinary trust provisions, would tend to apply to those. But by and large, they're designed to be, it's a corporate entity that will be deemed to be a trust entity. And so investors that hold shares related to a particular sub-fund will be treated as holding, I suppose, units in a trust. The reason for the changes, as Renee said, is to encourage international investment. So the focus of these rules, this new vehicle, will be for international investors. The thinking was that trusts, which are commonly used in Australia as collective investment vehicles, are too different and foreign, particularly for US and European investors that are used to corporate vehicles for investment. And so the idea is that these will be a familiar investment solution for those sorts of investors. Again, it's part of the overall strategy to enhance Australia's attractiveness as a financial services hub. There are some challenges for tax. Practically, this obviously will be a brand new structure that will be created for 1 July. And so there will be monies that go into this. So there will be some onboarding and learning required in relation to this. And one would expect, given the new law, that there probably will be tweaks and changes as we go, as time progresses. The big tax hurdles for this is that you won't be able to move from an existing trust fund into a CCIV where you have unrealised gains or real property. That's because currently there's no CGT rollover relief, which means if you were to transfer an asset that had an unrealised gain, there would be a capital gain realised in the old trust moving to the new CCIV, notwithstanding the underlying investors may all be the same. That may be an easy fix for an income tax point of view by inserting a new rollover provision. However, the stamp duty will be a challenge where we've got transfers of real property from a trust fund to a CCIV. This is because duty is paid and collected and regulated on a state-by-state basis. It would require all states or states themselves to introduce some sort of exemption criteria. Now, the last challenge I want to talk about is where a CCIV doesn't achieve AMIT status, and that could be because it's not widely held or closely held, or doesn't satisfy the no trading condition. If that's the case, as I said, the CCIV will default to being a trust, and where we have a trust, it's imperative that the income of the trust is distributed to unit holders in order for the trust not to be taxed. However, the rules for a CCIV mean that in those situations, trust income is deemed to be accounting profit per accounting standards, which will include all sorts of things that like revaluations and impairments. Those items won't be taken into account for tax, but may create a loss position if you have significant impairments or significant unrealised gains. In those circumstances, it won't be possible, particularly in a loss position, just to distribute income, which will mean the trust will be taxed on all distributions, even if there are physical distributions out. That is a particularly harsh issue. Won't be applicable in a lot of situations, only where the CCIB does not achieve ASIC status. And the last thing I want to talk about, and probably quite timely given the recent crash the depression of the cryptocurrency market, and I suppose the implosion of the Terra Luna coin, is taxation of crypto and digital assets. Now, there are no specific rules in place, aside from perhaps some GST provisions dealing with crypto that make things life a bit easier, which means we are required to shoehorn existing tax principles and rules around crypto, which often will end up with anomalous and often unfair results. Because of this and other reasons, and to ensure Australia doesn't get left behind from a crypto regulation point of view, Senator Bragg chaired a committee which released a report late last year making 12 recommendations. Those recommendations were then considered by the Australian government, and across a number of those recommendations, either accepted in principle, noted, or rejected. Green, orange, and red is accepted, noted, and rejected. And so token mapping was recommended. This will be critical for tax in that it will be critical to understand the classification of a particular token as to its tax treatment. There was a recommendation to establish a DAO legal structure like a company. Currently, it is the thinking is that these will be taxed like partnerships. Again, these will have pretty significant tax implications, particularly where DAOs are used for investment purposes. Where we have crypto interacting with decentralized finance platforms, you'll often have a situation where tokens or coins are legally disposed of, particularly where you've got staking or wrapping or swapping transactions, without actually having a practical disposal or a practical economic gain. There was a suggestion to have perhaps a rollover or disregarding of CGT events. That's something the government has looked at, has noted, but no clear sign as to whether that would be acceptable. And suggestion or recommendation put forward by the committee, which has been flat out rejected, is a discount for the company tax rate for green crypto miners. Now, finally, flowing from that particular paper, there's been a referral to the Board of Taxation, who will be looking at the ways to, I suppose, limit and reduce the anomalies and unfair results of dealing with crypto from an income tax point of view. They've released their terms of reference, which are there on your screen. I won't read them out, but the Board of Taxation is due to come back following their review of this by the end of the year, and SW is providing input to the BOT considerations through the Tax Institute. And that's all from me. Over to you, Renee and Rami.
Great. Thanks so much, Simon. Rami, let's see what is new. What are the hot topics for 30 June 2022? Now, I think the first thing that we'd be amiss if we didn't talk about is valuation of assets. And that's been a significant focus area for ASIC since the start of the pandemic. And I'd say after the initial roller coaster of equities, there doesn't seem to have been a lot of impairment. Properties seem to have been quite stable over the last couple of years. There's been some isolated impairment issues for specific assets that's directly been impacted by the pandemic, such as specific infrastructure that's highly reliant on tourism. But other than that, we've not really seen a huge problem in asset values. Would you say for 30 June 22, that's changing, or what are you seeing in terms of asset valuations for 30 June 22?
Yeah, thanks, Renee. Haven't seen any 30 June vals for 22 yet. They're imminently arriving into the inboxes of many of the fund managers at the moment. But you're right, property held up really strongly throughout the entire last 2 years. Many thought it might go down or hold. In fact, it went up significantly. it will be really interesting to see what happens with the current valuation cycle. Certain asset classes are going to behave differently, but the economic fundamentals right now, I think, are going to put pressure on asset prices, whether that comes through in the June 2022 cycle or in future cycles. We're going to find out. In the context of the financial reporting cycle, though, what I think is important is that where you're including the sensitivity disclosures in your financial report on the valuation, make sure they're clear and transparent. So things like the discount rate, I would imagine with the risk-free rate now forecast to be closer to long-time averages of, 2.5, high twos potentially, that's going to put pressure on discounted cash flows, which may mean that valuations are dropping. So including some sensitivity on the discount rate may or may not have been a variable that was done in years gone by. Perhaps you did sensitivity on things just like the cap rate or potentially interest rate sensitivity or other variables. I'd encourage you to look at that. Transparency is key. I think explaining what's been valued, what hasn't been valued is important. And, we are still in times of somewhat valuation uncertainty. So one thing I'm looking at, Renee, is our value is still going to include significant valuation uncertainty paragraphs in their reporting, or are they a bit more courageous now that things have maybe settled down?
It is going to be really interesting, and I think that's going to be really the main hot topic for 30 June 2022. And then the other area that we know ASIC is focused on is expected credit losses on loans and receivables. So this has been a significant focus area for ASIC in their surveillance program. And with inflation going up and interest rates rising, those kind of cash flow issues that you need to consider, because when you do an ECL provision, you also need to look at the future. And so the RBA have told us pretty much explicitly we'll definitely get more interest rate increases. And so I say when companies are doing an ECL provision, they need to also consider the future and the impact that will have on the cash flows of people that owe them money. So what kind of focus are you seeing on expected credit loss provisions this year, Rami? And do you think this is a major area for concern?
I would think for sort of the debt funds, they need to go through their process, depending on the type of debt fund you're managing. We haven't seen historical losses come through, to your point, Renee, but it is also about future losses. And I think fund managers with that asset class need to go through their process. Those that are in sort of the real estate, passive real estate sector, where they're collecting rents, I think the sector did very well at the beginning of COVID and generally went through an abatement process rather than try and defer amounts, generally speaking. So they're not now caught up with trying to collect amounts and look at credit loss provisioning. They really just took the pain earlier on. Some are still working through, for the record, those tenants that self-abated. But I think we're at the pointy end of that now, and that will be perhaps, certainly a lesser issue, I think, for the real estate funds.
And so in terms of covenant compliance of borrowings, the obvious covenant issue that springs to mind is an interest rate cover if interest expense is going up. And I think a lot of entities will be going back to their lenders and revisiting what an appropriate covenant level is for them. Are you seeing covenant compliance as a significant problem? And what other kind of issues do you think there might be in this space, Rami?
Yeah, so it's always a watching brief on covenant compliance. It really depends on how close managers are prepared to sail to the wind on their covenants. Debt's great when it's cheap and there's plenty of it. But in a rising in this sort of market, those that are heavily geared are going to see, both the impact of potentially LVR and ICR issues at some point. With the pricing of debt, seeing many organisations that are, obviously, if you're hedged, you're not going to have any issues on ICR until you become unhedged. But in the last 6 months, I haven't seen a lot of clients enter into hedging. It's been too expensive. So that they will be subject to the variable rate. They've got to watch it closely. Let's see what happens with the valuation cycle. In some ways, those that have higher gearing might have some impacts on the LVR when those shocks come through. But the key is the property still yielding the cash flow? And it will be really interesting. I think the challenge for the next 12 months for the particularly the real estate fund sector is, can it, for those leases that have the ability to escalate and pick up CPI, will they be able to increase their income to offset higher costs of finance?
And in terms of solvency and going concern, this has also been a key focus area for ASIC. I'm not sure whether in the financial services space that has really been that much of an issue, but in terms of solvency and going concern, what would you say entities in this space need to consider for their financial reporting for 30 June 22?
The big thing is making sure you've got a really robust model, particularly in the invest. So for those that are in sort of investment funds, make sure that you've got, and you will be, I know, forecasting your cash flows, include sensitivity, set out your assumptions, do some what if analysis, be really clear to your board why they, when they sign those accounts, that they think they're a going concern for the next 12 months. The only other thing I would add is don't be afraid of disclosure. A lot of clients, and I'm an auditor, a lot of clients get fearful of talking about this type of disclosure. What's important is think about it that you're explaining the story to people. Okay, you want to explain the position such that there's a level of transparency, not necessarily alarm, but there's a genuine understanding of if there are challenges, what are they, and how the directors are or the trustees are looking to work through the issue. You know, this issue is very much around disclosure. Be collaborative, work with your auditor, make sure the accounts really do explain your story.
Okay, great. And then the fifth area of focus this year is going to be provisions. So this is an item that's probably less relevant for funds or other financial services entities, but the types of provisions to be mindful of, just as a brief FYI, would be around onerous contracts. They can often be overlooked. Sometimes where an entity is given financial guarantees, you need to consider whether you have an appropriate provision there. And when there's any business restructuring going on, you might need to consider the need for a provision there. So that's the key focus areas. Thanks for joining me for that, Rami. Before we turn to questions, I'm just going to share the poll result with you from earlier. So our question was whether your company's had a cybersecurity review in the past 12 months, and 59% of entities have said yes, and 16% have said no, and unsure was 26%. So it does look like it is something that's on the agenda for entities, but also maybe not something they're communicating with all their people if they do it. And on that note, we have a couple of minutes left for questions. Rami, I do actually have a question for you. Rami and Simon, if you want to join me on the screen. I do have a question here for you. When you say that AFSL holders must adequately manage their cyber security risks, what would you say are the top 3 things they need to do to kind of manage their cybersecurity risk?
I would say a few things. One is, do they understand so there's an awareness piece. This is an emerging area. Do they understand what cyber security risk is for them? Okay, so that there's genuinely a piece of education for many executives and boards around this as a step one. And it might be that your CTO, IT person, or someone independent in the know can give you some base level education. The second piece is getting a baseline. So the concept of cybersecurity penetration testing, if you haven't heard that expression, it's a very common way for organisations to get a feel for their cybersecurity posture, where you engage a third party to, one would used to say, hack your system, see what vulnerabilities there are. Okay, so this is a really common thing. The cost of this is coming down as more and more organisations are looking to do elements of penetration testing. But there are some also, thirdly, I'd say, in addition, or perhaps as an adjunct to some of the cybersecurity penetration testing that you can do, there are some, unique things that are coming out through Microsoft, and there's some scores they can give you on, how your systems are, how mature they are to others. There's, and there's a few other, for example, the Australian Signals Directorate has their own ranking system of cyber. So I think the key bit, Renee, is if you don't know much about cyber and you're responsible for risk, go and find out.
Right, thanks for that. Look, we have run out of time, and here's our contact details. If there are any more questions coming out of today's session, please feel free to get in touch with us. We're always happy for a chat. So that brings us to a close today. Thanks so much, Rami and Simon, for joining us today. And thanks for all our attendees for your company today. We've loved having you here. We'd love to hear from you. If you have any questions, please speak to your usual SW advisor or send through an inquiry to any of our team on the screen today. We'd also value your feedback on the session, so please complete the feedback survey, which will pop up on your screen at the conclusion of our webinar. Thank you so much for joining us. Be well, stay healthy, and see you soon.